Senior Financial Consultant for the St. Louis MBDA Center. Today we're going to talk about access to capital in this difficult time of civil unrest. We have invited 4 experts in their field to share with you what they have to offer to help during this difficult time with access to capital being very limited. First, our panel of experts will present, and then I will ask a few questions and take questions from our chat room with the assistance of Jamaica Smith, our Business Development Manager. We will try and answer as many questions as possible. If we don't get to everyone, we will provide the contact information of our speakers here today. The only thing that we ask is that you email us so that we can track the information, which helps us to continue our continued support. We thank you, and now I will turn it over to Todd Gilliard, who's our Project Director for the St. Louis MBDA Center.
Thank you, Jamila. Thank you, Jamila. And I would like to thank you all for attending our Money Talk webinar series. As Jamila stated, it is a critical time within our country. Large, medium, and small businesses are closing, and others are facing that same outcome. That's why here at MBDA, the Minority Business Development Agency Business Center of St. Louis, along with our managing partner, the Chicago Minority Supply and Development Council, we are dedicated to help businesses during this critical time. We have assembled our financial partners together, strategic partners together to help. So please pay close attention, write notes, be prepared, and I will talk to you afterwards. And I thank you again for attending. Now, Jamila.
Thank you, Todd, again so much. First, I'd like to introduce my guest panel before we get started. They're no stranger to the market. They're seasoned lenders, and they've been around doing this for a very long time. First is Arlene Martin. Arlene's with Huntington Bank. She's the SBA. She's VP of the SBA Business Development area for the bank. Also, I would like to introduce Alex Fenoy. Alex is no stranger to both the St. Louis market as well as Illinois. He's the Executive Vice President, Community and Economic Development Director for Midwest Central Bank. Thank you, Alex, again for being with us today. And then I'd like to introduce Steve Monroe. Steve and I have worked on many different projects working with MBEs over the past several years. Steve is the Managing Director with Liquid Capital. And then not last but least is Maureen McKenna. Maureen is the Senior Development Officer with the Community Reinvestment Fund we call the CRF Fund. Thank you all for being here today. Arlene, you want to get started?
Absolutely. And it's just an honor and a privilege to be here this afternoon to share valuable information about SBA lending. And I've been in the industry for over 30 years and a part of Huntington Bank for the last 2.5 years. A little bit about Huntington Bank. We are the #1 SBA lender in the country in terms of loans closed. And so we do a lot of SBA lending, and we really have a passion for working with small businesses, whether they're in the early stages of development, startup companies, businesses that are seeking term core working capital to either expand, grow, or to pivot their businesses. And during this challenging time, we are seeing quite a few businesses that are actually taking the opportunity to reassess and to pivot into a little bit different business model than they have had in the past. We also fund real estate deals, equipment purchases, business acquisitions, etc. So this afternoon, we have a short time together, and I wanted to cover some of the basics about SBA lending. And so to get started, a few things that I wanted you to know about the SBA is that it is the Small Business Administration, which is a government guaranteed loan program, and Huntington is a preferred lender. Loans that are funded with the bank are typically guaranteed at 75%, and loans that fall into the Express program are guaranteed at 50%. Some new and exciting legislation was just passed last year, at the end of the year, where that 75% guarantee that you are seeing is going to increase up to 90%. And what does that mean? what it means is it gives the bank a little more flexibility as an SBA lender to make loans that they might not have been able to make. So it gives more flexibility, and it gives you as a borrower the opportunity to pursue the SBA lending that you might be interested in. So what can the SBA loan do for you as a borrower? They offer extended loan terms, amortizations, longer amortizations that will improve your cash flow. It will reduce down payments, cover collateral shortfalls, and provide credit where it may not be available elsewhere. It mitigates change of ownership risk that occurs perhaps when you're buying a new business. It eliminates financial covenants, and we also look at the entire project when we're considering the project for all costs that are related. So there's a lot of advantages to considering SBA financing. One more thing that I would mention here as well is that the fees going forward for the next 9 months will literally either be waived or they will be reduced. So this truly is an avenue that I think you might want to consider looking into. And I know that on the group panel today that the 3 or 4 of us definitely will be able to assist you with that. So additionally, on the basics, key eligibility rules include the business owner will typically own 20% or more of the business, and those that do will provide what's called a personal guarantee. They will pledge assets as collateral to secure the loan. Loans cannot be used to pay delinquent taxes or flow back to owners or key employees. Loans must also be made to a for-profit entity, and individual business owners must be U.S. citizens or legal permanent residents. So the programs are such that the 7A program generally at Huntington starts, well, we look at loans at $350 and above up to $5 million. However, smaller loans are definitely looked at as well under that level. The loans can be used for startups, business acquisitions, for goodwill, debt refinance, commercial real estate purchases, equipment leaseholds, etc., as I had mentioned a little bit earlier. The other SBA program is the 504 loan program, which is available for larger purchases of equipment or real estate. Again, the SBA Express loans are under $350, and the Quick Express loans are $100,000 and below. So acquisition. So at some point in your business cycle, you may want to acquire a business. That's definitely something that we can handle for you at Huntington. And with that, the terms are and amortizations are 10 years. The loans can be longer if there's a real estate collateral pool. Typically, business assets are what we're looking at here. Goodwill is okay. We're looking for strong cash flow. Collateral is not always as critically looked at, and seller notes are welcome. So a little bit more on BizX, but I'm going to move on. So there are real estate purchases that are also available. You must be owner occupied and have at least 51% owner occupancy. Typically 10% or less is required, and up to a 25-year amortization. So if you're looking to build and to do leasehold improvements, you can do that all in one loan. In addition, there are equipment loans that are offered, and they're generally offered up to a 10-year period with 10% down. And if you're an existing business, you might not have to put any equity at all into the deal. And lastly, we have leasehold improvements and expansions as well. We need to understand the project budget. Have you hired a contractor? Things of those nature. But that's an excellent way to move out of if in fact you are in an in-home business setting and you would like to expand and move into space as well. So these are some of the basics that I shared with you as part of what we can offer to you at Huntington. The PPP loan program has just kicked off, and so that is another valuable resource that all business owners should consider, and that is also available at Huntington Bank. And with that concludes my presentation. So Jamila, I'm going to turn this back to you.
Thank you so much, Arlene, for that wonderful presentation. And we're going to get into questions after we've heard from all of the panelists. Our next speaker is no stranger, Mr. Alex Fenoy. Would you take it away?
Thank you, Jamila. How's my sound?
Excellent.
All right. All right. Let's make sure we can see this. And screen?
Green is great.
Perfect. Perfect. Get back to the presentation mode from the beginning. Okay. Thank you all. It's such an honor to be with you today with St. Louis MBDA and all of your members that's a part of this. And I'm gonna try to do it in 15 minutes. It's a lot to cover, but hopefully it'll be a help to someone. So I'm starting my clock now. So first, just a little background of who Midwest Bank Center is. We're the second largest privately held bank in the St. Louis market, 2.3 billion in assets actually, and 1.4 billion in loans. And one huge thing I want to point out right on the beginning of this page is over to the right, $95 out of every $100 deposited in any of our branches are reinvested in the St. Louis market. We think that's hugely important because as St. Louis grows, we need to be a big part of that. So that's our intention, and that's what we want to continue to do as a financial institution. This is probably my favorite slide. If you know a little bit about my background, my area within the bank that I'm responsible for is community and economic development. And we look at that as being the real heart, if you see in the visual, of who the bank is. A little different model than some of our competition, not to throw rocks at anyone, but we like to keep our CED and the work that we do in the heart of all of the business units of the bank. It's not just in my area, it's in the bloodline. If you get the visual of a heart and pumping throughout commercial, throughout mortgage, throughout consumer, throughout retail, throughout all of the other fee income areas, throughout the legal board, the ownership of the bank, all of the team members at Midwest Bank Center, being responsible, being passionate about community and economic development is at the heart of who we are. Love this slide as well. It really just talks about profits and purpose. So all of us here, or at least most here, are for-profit business. And I would hope with you being a part of MBDA that there's something bigger than just a profit. It's about a purpose. And we want our purpose to do these three things here: further our clients or our customers' prosperity, fuel the future growth, of the entire St. Louis region, and then be a key part of societal or big picture changes that need to improve within the entire country and specifically within St. Louis. But at that lens, we still have to know that if it's not profitable, then it's not going to be sustainable. Our focus at the bank, when we define, just so we're all on the same page, LMI or low to moderate income areas or underserved communities, we kind of use those interchangeable. We're looking at communities that have historically been disinvested or left behind. Our strategic focus is to go in those communities and help raise them up, to be a catalytic positive change in the improvement in those areas. So another way of looking at it is a forgotten community. St. Louis as a region will not be the best that we can be if we have huge swaths of areas that have been left behind and they continue to be left behind. So how are we going to achieve that? Not going to be able to in detail hit all of these. I'm going to try to hit the initiatives on the left-hand side of the screen. So we just announced publicly that we are committing in our CED 2.0 model to lend only about loans over $200 million over the next 5 years, with 80 to 85% of that being in the St. Louis region. At the beginning of the presentation, I talked about us being a $2 billion bank or $2.3 billion bank. A $200 million commitment in this space, we think is tremendous. And I want to harp on it again. It's about loans to individuals, to small business, to faith-based institutions, to not-for-profits, to community development projects, all in those forgotten communities. Those are the only loans that we're talking about counting in that bucket. If we do this and we do this successfully, we think we can be a part of positive catalytic change in those communities. Second thing, well, I'll keep moving. Just some statistics that we did a partnership with Washington University, and we were their guinea pig for what is the impact of working in underbanked or unbanked or forgotten communities. And I'm not going to read everything on the slide here, but at the point in time when we looked at those two branches for us, which is our Pagedale location and our location at Friendly Temple Missionary Baptist Church in North St. Louis, the commitment or the impact was as stated here. A regional economic impact of over $11 million, an impact of over 124 jobs, an impact of income to the community of $6.2 million. Home ownership, additional wealth of 1.8 million. Financial education, working with, especially with the younger end, and this will be the last thing I'll say on this slide, over a wealth accumulated dollars, if they keep on the track that they're going, of $7.1 million. I stepped on this a little bit earlier with our CED 2.0 model, our goal, and again, talking about the focus and the 40 million, and again, at least 25 of that being in the St. Louis region per year for 5 years. This is what we define as the St. Louis region, because we have either a branch or a plan within our next 5 years to be in all of these markets. St. Louis City, we're in St. Louis City, St. Louis County, St. Charles, Jefferson County, and the Metro East today. We're looking at other loan production offices or micro loan production offices across the country that fit within our strategic initiative. A little more detail into the types of entities or partners we like to use at the bank that we'll be looking for to work with and continue. Again, strategic partnerships with key not-for-profit organizations, with pillar churches, creating a multicultural advisory board. We still have an advisory board system that'll come up more. Clean energy and solar projects. We've begun to stick our toe in the water in that space. Financing opportunities, distressed municipalities. Begun that process as well. New market tax credits, opportunity zones, and this is a big one for us. Participating in syndicated credits with Black-owned banks. Looking at several right now to begin that process. I think that's uniquely important for a majority bank to be a part of. The Rising Together Foundation. This is about bringing in other deposit dollars, like think of the bank's charitable dollars, but creating a foundation that really helps homeowners and small business be successful. And once we grow it to scale, then even be that gap financing in community development projects. So more to come with our foundation. That is being launched first quarter of 2021. I'm gonna keep moving. Here, we're beginning to start this. We started actually last quarter, and we'll get it off and running this year and into 2022, looking at creating a 35 board member, a multicultural board. And it's important to us. Our philosophy is about being for the Big Ten and being open and being the bank of choice for any and everyone who needs a financial partner. So to be able to do that and do that effectively, we need to have more people at the table from different backgrounds, different thought processes that can help us navigate those waters. So that's why we're creating a multicultural advisory board. Small business, Arlene did a fantastic job with that. We're also an SBA lender, and a big part of the first round 1 and 2 of the PPP did over 210 million, 1,400 loans in the first round, and we will be a part of round 3. One last thing here that I want to touch on. This is an area that's been difficulty for especially small businesses, women-owned, or people of color. We've taken a hard look at this and are improving, I'll use the word improving, and challenging ourselves to be more flexible and more fair across the board with our underwriting. So it's a busy slide, but this is just showing how we're doing that in our consumer and in our small business space. So more to come here, but it's important because the key is having access to capital. And we can all talk about all these things, but at the end of the day, if we're not helping businesses navigate to get to an ultimate yes, then we're really not moving the needle. So our idea or our plan with what this is trying to show is that we are moving the needle and that we are continuing to challenge ourselves. And one last thing I'll say with it, with just my space, the 50 CD at Midwest Bank Center today is a portfolio of about 50 million. We've had in the last 11 years, so it can be done. We've proved it. We've had only one charged off loan of that 50 million roughly in the last 11 years. I'll put those statistics up against any other segment of any other bank. And I think I'll pause and leave it there.
Well, Alex, that was a lot of great information. And of course, I have questions for you, but I like the fact that we're going to get to an ultimate yes. That's what we're all about here today. And the fact that there have been no charge off, that's just remarkable for the past.
For one.
But the one, and I haven't, been an ex-banker myself and worked in workouts, so I really understand that's great. That's really good news to hear. And now I'm going to open it up to Mr. Monroe, Steve Monroe. Thank you for being here, and take it away.
Thank you, Jamila. I'm just getting myself loaded up here. Hello, everyone. Thanks so much for the introduction and for the invitation, Jamila, and to Todd. It's really a pleasure to be a part of the Money Talks series, and also to be on a panel with a number of like-minded professionals, like-minded lenders who are all interested in trying to get capital to our small and medium-sized businesses. So let's dig in. I know we've got a brief time together, so I'll dig right in. So today we just want to cover, want to give you a brief overview of Liquid Capital, describe our financing solutions, and then of course we'll have Q&A and time to dig into them in more detail. So as Jamila said, my name is Steve Monroe. I'm a managing partner with Liquid Capital. I joined the firm in 2016 after 25 plus years in banking and finance. Liquid Capital itself was established in 1999. We have over 50 independent offices across the US and Canada. And since its inception, the company's really been focused on trying to provide cash flow solutions to small and to medium-sized businesses. Our core competency, and the common thread in all our solutions is really products that focus on accelerating cash flow. I think, as we all know, cash flow is the lifeblood of small businesses, and so, and can very often mean the difference between successful and being challenged. And so, most of our solutions do focus on cash flow. As I mentioned, we're asset-based lenders, and so our approach to risk often allows us to lend to those companies that don't qualify for bank funding. Our approach is we lend against assets and look to the assets as our primary form of repayment, as opposed to primarily looking at revenues, income, debt and equity, et cetera. I mean, those values are important, but we really look to the asset as a form of repayment. So in terms of the product suite and the items I'll cover today, we'll really focus on 4 products. We'll start with invoice financing. We'll move to purchase order trade finance. We'll touch on equipment finance, and last but not least, we'll talk about our asset-based line of credit. So with respect to invoice finance, really this product is a financing vehicle that again allows folks to accelerate their cash flow. It is a product in which effectively you provide a product or service. Once you provided a product or service to your customer, we'll buy that invoice, right? Typical transactions, as you know, in typical transactions, you end up waiting 30 to 60 days and maybe longer in some cases to get paid. What we do is we try and accelerate the cash flow and release the value of those of the capital, release the value of it in those invoices. So a great example would say I'll just use a round number. It's a $10,000 invoice. You've done work, you've completed it, you've submitted the invoice. You would typically wait 30 to 60 days to be repaid. If you use the invoice finance product, what we do is we buy that invoice, we advance against it. We advance roughly 80% against it, 80 to 85% against the invoice. So you have on a $10,000 invoice, you have $8,500 in your pocket, in your company's pocket, right, in your coffers to use to address payroll, to address any other expenses, right, to put it back into the business and use as you see fit. Once the invoice has been paid in 30 to 60 days, we return the remaining 20% to you, less fees. And fees for us are anywhere from 2.5% to 3%. So on an example like that, on a $10,000 invoice, the cost is about $250 to $300. Obviously, if it's a $100,000 invoice, then that's a $2,500 to a $3,000 fee at the end of the transaction. And again, what it allows you to do is just accelerate your cash flow, right? Who doesn't like a product that allows you to get the value to be paid for your work earlier? You get paid for that work earlier at the expense of a discount, right? Shifting gears a little bit, one of the other core products on the platform is our purchase order finance product, and essentially we lend against our clients' purchase orders. So if you are a client and you've received a purchase order from a creditworthy customer to provide widgets, and you don't have the capital for the widgets, we finance the transaction. So based on the strength of that purchase order, we would buy the product for you. We would buy the widgets for you from your supplier. We would fund them. We would induce them with that payment, induce them to purchase or to produce the widgets. The widgets get delivered to your end customer. Your end customer pays and pays down. We use the proceeds to pay down the purchase order finance team, who's funded the manufacturer or the supplier, and you get the balance, which is effectively your fee. Sorry, is your P&L. That again is roughly about on the cost of the goods. That's roughly about a 2.5% to 3% type fee. And again, it allows you to facilitate this purchase order finance transaction without ever having to dip into your cash flow, right? It's a cash flow transaction, cash flowless transaction from your perspective. Just moving forward a little bit, sorry. The next, as I move through this, apologies. The next product we want to touch on is our asset-based line of our asset-based lending line of credit. And this particular product essentially is a line of credit that looks to the value of a pool of assets. So we would look at assets like accounts receivable, assets like inventory, could be property, could be equipment, and we pool those assets together, right? It's a tangible, eligible pool of assets. And we look at the value of those assets. We would ascribe some sort of loan to value against it. Could be 75 to 90%, depending upon the asset. And we come up with a borrowing base. We come up with a number that we provide to you as a line of credit value. And then you execute on that line of credit and you use it as you see fit. This particular product is usually for larger, more established companies. The first two solutions, the invoice finance and the PO finance, are products that work for clients large and small, newly established and mature businesses. With the asset-based line of credit and the next product that we'll discuss, the equipment finance, that's usually for it has a larger line requirement. So usually these are about $1 million and higher in terms of the line, and same with the equipment finance. So it's usually a more well-established, mature business, but it's not necessarily the case. But this is a great product in that it just allows you to leverage assets that you have in the business and put them to work for you. And then the last product that we'll chat about is equipment finance. And so, the equipment finance product is one where we look to, and clients love this one, as they do the others, but they really like this one because it's a product that allows you to leverage, again, the value in your equipment. We don't necessarily look exclusively at the client's financial wherewithal. We're not necessarily focused on the balance sheet and income statement. It matters, but to a much lesser extent than you might imagine. And we really focus on the equipment, right? And so what we do is we get an equipment list from you. We send in an appraiser to value the equipment for us. We'll assign an advance rate. Once we understand the liquidation value, we'll assign an advance rate to you and come up with a loan amount, right? And loan amounts in this space, range from $1 million to 15 million. But again, the beauty is it just allows you to extract value from the assets or from assets that you have in the business, and leverage them and allow you to get capital from them. The terms on these, they're usually anywhere from a minimum of a year to as long as 48 months. This slide, why liquid capital? I just think that I don't want to make this a liquid capital commercial by any stretch, but our approach is to be very much it's to be partnered with our clients. We're timely. We have a number of different solutions, and we try and provide customized product solutions that work for you. I know we're going to have questions later, so at this point I'll turn it back to Jamila, and I look forward to speaking with everybody during the Q&A. Thanks very much.
Thank you, Steve. Thank you. We've worked together, and certainly the MBEs have been very excited about working with you over the years, and we've had nothing but good reviews. And so thank you for bringing us home with a lot of our transactions. And last but not least is Maureen McKenna. Maureen.
Good afternoon, everybody. So it's wonderful to be able to share with you and participate with the Business Center there. I'm very impressed with the panel of people that I am working with here, and they have a lot of good information to share with you. But I'm going to try and share my screen to give you a little bit more information about my business, which is Community Reinvestment Fund. Community Reinvestment Fund is a national community development organization, community development financial institution, And we are national in focus. And we really look for creating equitable economic opportunities, lead through collaboration, transform through innovation, excel in all we do, and act with integrity. And I would say over this last year, the lead with collaboration has been really high on that list. In the course of the year, with the pandemic and everything going on with the unrest, we've been able to collaborate across the nation to provide impact to communities and to small business. So this gives you an idea of all the lending we've done. We've done over 4,000 loans to businesses and $3 billion in financing since our creation, which started in 1988, where we did securitizing loans for home ownership. And in 2011, we bought our SBA 7A license. And since that time, we have been working on 7A loans. So in our loans, we, as this slide indicates, our loan size is from $150 to $5 million. The credit challenge, because we're a preferred lender, we're able to do loans at a level that maybe traditional banks would not be able to. So the borrowers and guarantors with credit scores below 640, collateral gaps or no collateral, businesses that have experienced recent losses, specifically recently with the large historical year-end losses, manufacturing, childcare, retail, service business, startups, and early franchise concepts with fewer than 5 locations. And because we are a mission lender, we are really looking at community impact. How many jobs are you creating? What is the impact on the community? We are always looking at what your use of funds are, and inside of the loan application, you really do have to indicate in pretty much detail how you're going to be using it. And we can look at that in order to purchase real estate, purchase a business, to provide monies for equipment, debt refinance, leasehold improvements, and permanent working capital. And we continually have people that are looking for maybe one or both or maybe all. And depending on their ability to get a loan, we're able to do that. How do we get started? We do have a lending site. It's called Connect to Capital. And we have to just answer a few questions and then your business and about your business and your financing need. And a member of the team would be I'm going to go back. Sorry, that went too fast. A member of the team will be in touch with you. They're going to ask you to gather some information, which is going to include a business plan, financial statements, projections, and personal financial statements. You're going to be working with our underwriting team, which is going to be looking at all the information you submitted and may have other questions to really get an idea of how they can best serve you. Once you are approved, then you go to loan closing, and that's where you'll sign all the loan documents, and the funds will be dispersed. So this past year, CRF did participate in the Paycheck Protection Program. We did over $521 million worth of lending with PPP, as well as in the Chicago market, we did about $43 million in the resiliency fund that we did with the city of Chicago. We anticipate that our application, they just opened up the PPP, but because we just received the guidelines, we'll be opening up on January 19th. We are working through a lot of our partners to be able to have opportunities to get to communities of need, those people that are most in need of these funds. And however, we also have an opportunity to go to our website, crfusa.com/PPP updates, and subscribe to the updates. And if you fill out a short questionnaire, you'll be responded to with an email invitation to begin the process. That's just a little bit about this. I have a lot more I could share, but I think with the questions, we may get to more of those. So I'm going to turn it over to you, Jamal.
Thank you, Maureen. Thank you so much. And certainly we've worked with CRF over the years with you, as well as Keith Retchie that we met years ago. And so we've had success, our organization working with your group. So thank you. And the presentation was very well put together, the whole
Thank
process.
you.
Thank you. So
Thank
now
you.
everyone just did a wonderful job, and just thank everybody. But I do have a few questions, and I know we're certainly going to open it up to the chat room right afterwards. But something that kind of came into mind, Arlene, because I know we've worked together, when you talked about, the personal guarantee, because I get that a lot. Do I have to personally guarantee it? I don't want to tap on my assets. And so are there any instances where the borrower can get around the personal guarantee? That's a question that comes to mind.
That's a great question. Yes, unfortunately in the SBA world, no, that isn't possible. It's a requirement of the bank that we have it, and I almost think it's a requirement of SBA.
Mhm.
And the thing about a personal guarantee is that by placing that in providing that, you are actually telling the bank that you believe in your project so much that you will stand behind it, and even to the point of placing that guarantee. So, and it's skin in the game. Some of the loans that we're going to do are more than likely going to be unsecured, and depending upon what level of personal assets you have, there may not be a whole lot to chase after either, which is another thing to consider. But yeah, I not on the SBA world. Now, in a conventional basis, there are certainly ways to negotiate those types of limited guarantees, or hire companies that have really strong revenue and really strong guarantors. There's a time and a place where perhaps, but sadly it's not really in the SBA arena.
Sure. Okay. Well, thanks for answering that question. The other thing that came to mind was kind of, the SBA obviously is it's not the more conventional. I did more conventional loans than the SBA. I did a few SBA loans, but kind of what is the process? I know I get, people think about the SBA, they want everything. They want,
Right.
It's everything. Well, it helps with if there's a collateral shortfall, but just can you kind of go into that just a little bit?
Sure. So the process, if to make an application with Huntington, what we would do is we would ask you to provide an application package, which would include the last 3 years of business and personal tax returns. If a startup, then a business plan. And actually, we do fund startups at Huntington, and not all SBA lenders do that. What we're looking at a lot of times, and historically, there was a time when cash flow wasn't quite as critical as it is now. It always is, right? Everybody would hopefully make money. But with COVID, I will say that we as an organization, as a bank, are really looking at it. We understand that businesses are impacted. There's no question that the impacts have been significant. But what we can do is look at the cash flow and look at the revenue and the income and say, provide us some projection, show us the pathway that you can get to, so that you literally can be able to repay the debt. So that projection-based financing model definitely has come into play in 2020 for us at Huntington, and it will certainly come into play in 2021 as well. Does that help, or would you can share more too?
That helps, but you mentioned, now obviously with everything that's going on, and we talk about how do we get to a yes, and obviously a lot of companies are struggling now, and I know traditionally we have covenants that we put in place that we look at, as benchmarks. And when you mentioned cash flow, I thought about the covenant, it has to be 1.2 or 1.25 times.
Right.
Is that still the case now when you're evaluating credit? Is that still, everybody's kind of shaking their head? Yeah.
It's a benchmark. Oh yeah. Yeah, we have to have that in place. And SBA has few other covenants than that. I mean, we require financial information every year, of course, as well. But the debt service coverage is probably one of the key things. And it's something, as we look at the deal, we'd like to see you achieve that. And certainly last year in we were looking for debt service coverage of 1.2 as of year end 2019. This year, we haven't had enough transactions yet. It's only January 11th or 13th. But you know, as we go through, we're looking at it with a little different lens too, because of the 90% guarantee. That changes the game.
That changes significantly.
It's huge. It's so huge. So, and I know in Steve's world, he probably is able to have a lot more flexibility in terms of cash flow, right, Steve? Because of how you're looking at deals.
Sorry, I was on mute. Yep, that's
Right.
absolutely right. Yeah, exactly.
Mm-hmm.
Right. Our product. I mean, we're there to actually try and shore up and that particular area if it's an issue, right? We try and accelerate cash flow with a lot of our products. To your point.
Mm-hmm.
But I like the part about Steve is you guys can actually work together.
Oh, yes. You know, I think the end game for all of us, everybody here on, you know, today on this, in this presentation, is we really want to help business owners be successful.
Absolutely.
So,
That's right.
can we partner together? Can we share the relationship? Can we strategize? Can we bring in groups like the MBDA that helps businesses prepare? Because if you think about it, the way the business owners don't always know what banks are looking for. And I'm quite confident that you're working on that behind the scenes to get them prepared and get them ready. And in doing so, and one of the things I will say is coming in with a really well put together financial package really makes such a difference. And, you know, understanding the why of your business. Why are you doing this business? You know, what is it that, why do you get up every day to run your business? What excites you about the business? Mm-hmm. Bringing a little bit of that, bringing the passion, bringing your expertise. You know, when you're presenting to the banks, you're also selling us on your idea. And so it's real important that you think about all those things and, you know, put together a really solid package as well.
Yeah, I couldn't, Jamila, if I could jump in behind Arlene, I couldn't agree more with what she has been saying and with Steve. But one other point that, and we haven't had, it's January 13th, so we haven't had a ton, and nobody's really looked at most companies' 2020 financials yet.
Right.
So, but the caveat's going to have to be, that's why it's key to have a relationship with either Maureen's group, Arlene's, Steve, Midwest Bank Center, whoever, because not everybody's 2020 is going to hit those hurdles that we're historically looking at. We know that right now.
Right.
So what are you saying, Alex? What I'm saying is you're not going to throw the baby out with the bathwater. So if you've got a long-term customer, it's going to be more difficult for a new one that none of us have a relationship with. But our existing customers, we should know, and we should already be having conversations about second quarter 2020 decimated me, for example, but I've twisted and turned and pivoted in my business, and we've done this, and now it's looking like what 19, 18, 17 was before. Just as an example. Those conversations are going to happen all of this year. And the more each of us, the four here, and other financial institutions are open to that, we can help save businesses. Because we can't just foreclose on everybody. We can't,
exactly.
Right? And we don't say that enough, in my opinion.
Right. But one of the things I just want to, and now that I have you, Alex, is that you talked about the shared prosperity. You mentioned the whole program. Can you just elaborate a little bit on that, just a little bit for me?
Sure.
Then I'm gonna move on to the two others, and I know I'm just being mindful of time because I know time is moving.
I'll be very quick on that. Okay. It's really as simple as we're a community bank. We're not all over the country today. We have aspirations to grow into the Midwest and in other places. But today, we're St. Louis region. We're only going to be successful if the St. Louis region is healthy and successful. If the St. Louis region has tons of businesses that close, mortgages, and people lose their homes and foreclosures and all that, that's going to have more of a direct negative impact on a community bank like Midwest Bank Center than it would, I won't use any of the examples, than a Bank of America, because they're everywhere. And so that can be spread. So the shared prosperity is about us, Midwest Bank Center, and our customers and the community at large sharing in each other's prosperity, each other's success. It's a simple thing.
Thank you. Steve, I know that there were some questions and you kind of answered the why do business with liquid capital, because the first thing to come in mind when people think about alternative financing, especially accounts receivable financing and such, that it's expensive. You know, you're looking at very high interest rate and high fees, that sort of thing. And so I guess you mentioned something about startups. What size, I mean, when you say startup, that means someone who's been in business like yesterday, or can you?
Sure. Great question. We can look at pre-revenue businesses. We have not all of them work, right? It's going to be a subsection of them, but we definitely have pre-revenue businesses that we've added to the platform, you know, as clients when, you know, if the business model works, if they have a product or service, you know, in the case of invoice financing, if they have a product or service that they're invoicing a creditworthy client for, we can absolutely help a brand new business. Same is true in purchase order finance. We'd like them to have a little bit of capital in the business, but they don't have to be exceptionally capitalized, right? Again, we're going to look to the strength of the purchase order and that purchase, the strength of the purchase order in financing the transaction. So both of those products definitely work for new and or smaller businesses, and it really kind of allows them to punch above their weight. Certainly in the case of the purchase order finance, I mean, we've added new businesses who've received purchase orders from really large businesses, and you know, and I'm thinking about one recently where a company had been in business for 3 months. They were established for 3 months. Owner had experience, but the entity was 3 months old. And we did a $750,000 PO. We were able to execute. So it can definitely happen. I don't want to say we can be all things to everyone, but it definitely can happen and has happened often.
I know you certainly have emergency situations with our MBEs that you've been able to. I won't say 2 weeks, but it's been 2 weeks that you've been able to turn around and substantial. We did something recently for about $17 million. That you were able to turn around right away. So capable of doing. Maureen, you're next, and you talked a little bit about the PPP. Can you just kind of give us a bit about that before we take it to step?
Sure.
Make sure all lines are muted.
So I just wanted to let people know what the qualifications were for PPP, because it will be the same no matter where you're applying. And also I will say that if you have a prior PPP loan, you should go back to your original, the original organization that provided that loan, because you know you'll be first in line with them. And in fact, for CRF, people that want to get a loan that have had a previous loan just have to watch their emails, because we'll be getting in touch with them. But the qualifications really are that you were in operation on February 15th and had employees. Now I'm reading really from the directives from the SBA that had employees for whom you had paid in salaries and paid payroll taxes or paid independent contractors. You have to submit documentation sufficient to establish this eligibility and demonstrate that you are qualifying, that the qualifying payment amount, which can include, and you can show that through payroll records, payroll tax filings, Form 1099, Schedule C or Schedule F or Schedule 941, and expenses from a sole proprietorship. You have to be a resident of the United States. They'll ask you to provide a driver's license for verification. So I think that those are the qualifications. And beyond that, once you meet those qualifications, then you have the opportunity to apply for the loan. And the things that are included in that loan would be any 12-week period from that time period that you're working, and you're going to take that 12-week period, you're going to multiply that by 12 and divide by 12, I'm sorry, and multiply by 2.5, and that is the amount of the payroll you will have. You can also include mortgage interest, you can include health benefits, you can include, this time around, you can include any damage to your property due to the civil unrest, and also any health benefits that are needed as a result of the pandemic. So it's a broader reach for this, and also any of your supplies that were mitigated due to the civil unrest. So it's important that people know all that so that they can now, while they're waiting, prepare themselves and get all those records together, because you do have to present those records.
Yeah.
Thanks. That's a lot of good information. I didn't know that, but that's great. Thanks for sharing. And so what we're going to do now, I mean, just think all of you guys, we're going to go ahead and open it up to the chat room. Jamaica, can you kind of assist with what's going on, questions that have come up?
Yeah, so we have a question for Steve. The question is, when Liquid Capital performs purchase order financing, will diverse businesses be able to pass the test to perform a commercially useful function if Liquid Capital is purchasing the materials and not the diverse business contract?
Got it.
Interesting.
Great. Yeah, great
That's
question.
a great question.
Yeah.
Sorry.
So you know, it is a great question. And so, you know, the way I articulated the product, you know, I probably should have been clearer and sharper on the point. So when I say that we'll pay the supplier, in that case, it's really a loan to you and you're paying the supplier. We just direct the capital to the supplier, to the manufacturer. But it's a loan. You have responsibility for repaying it. It's a loan, right? That's just going directly to manufacturer X. But it is, you know, the loan's in your name. It's your, you know, quote unquote, it's your exposure, right? And so from that perspective, I think you do pass muster in terms of the commercially useful function question. Hasn't been an issue with other diverse businesses who have done purchase order finance with us. Let's put it that way.
Okay, thank you.
And happy if you have any other questions on that, please feel free to reach out to me directly. Happy to chat about it further.
Yes. The next follow-up question to that was, will diverse contractors qualify for the MWDBE credit when Liquid Capital purchases the material directly?
Right. Again, similar. I think the question is pretty similar. Same answer, right? I should have been tighter on the point. It's not us directing, it's not us paying per se or buying the materials per se. It's us just directing payment. It's a loan from you. We direct the loan proceeds, but it is a loan to the business owner for those products or supplies and materials.
Okay.
Does that make sense?
Yes.
Is that clear? Okay.
Okay. This is for all of the panelists. Do any of you handle business in the Kansas City area?
I'm going to answer first. I do not, unfortunately, and I have to leave, so I apologize. I have another meeting.
Thank you so much. Thank you so much.
Bye, Arlene.
Thank you, everybody. Bye-bye.
Bye, Arlene.
Midwest Bank Center does.
And also, CRF is a national funder, so we are all around the United States.
Yeah, same with us. We're national. We're in every jurisdiction, including Kansas City.
Okay. We have a question. I believe it was for Arlene, but the question was, for the PPP, what 12-week period will they want to see this time? And then do you have to show 25% revenue loss?
Yes.
Yes, the 12-week period is really any 12-week period in the 2019 to 2020 period, and for employees that whose place of residence is in the United States, and And beyond that, you just have to qualify that with the payroll journal or bank statements or your tax records, be it 941s or Schedule C or Schedule F.
Yeah. And just to add on to Maureen's answer there, and fully agree with it, but just think of it as you would have to compare first quarter 2020 to first quarter 2019, or second quarter 2020, second quarter 2019.
Mm-hmm, mm-hmm.
And you also do have to show 25% loss.
Correct.
Okay. Okay.
And then another, Maureen covered so much of the PPP. But there are two other specific industries that actually will, the calculation that she did, times divided by 12 times 2.5, and
Yes.
that's restaurants and hotel lodging actually is 3.5.
Mm-hmm.
So if your
Correct.
industry
Correct.
is that, you actually get an increase. But it's you covered 99%. I'm doing the 1%.
Thank you. I mean, thanks. That's as a result of what happened last year and looking at the historical information.
Looking at those businesses being, those industries were more negatively impacted than others.
Correct.
Okay, well, that is all of the questions in the chat room. I did see a hand raised, Ms. Sheila Jackson.
She's Sheila Johnson.
If you have the question, please post it in the chat room. Thank you. But because of time, if you do have any questions, I'm going to be sending all of the content from today's presentation to you via email, and along with all of the presenters' contact information, and you will be able to send your questions directly to them. So, thank you.
Thank you guys for today. This has been wonderful as always.
Thank you very much.
Thank you. Thank you.
Thanks, everybody.
Have a great day.
Thanks, everyone. Part of this panel. Outstanding group.
Agreed. Likewise. Take care.
Take care, everyone.
Bye, everybody.